Nick Leeson and the collapse of Britain's oldest investment bank. In February 1995, a single 28-year-old trader sitting in Singapore brought down an institution that had survived the Napoleonic Wars, 2 world wars, and countless financial crises spanning more than 2 centuries. Barings Bank, founded in 1762, wasn't just any financial institution. This was the bank that had financed the Louisiana Purchase for Napoleon, bankrolled the British war effort against the French Empire, and helped establish the emerging economies of Argentina, Chile, and Uruguay throughout the 19th century. The Baring family had built their fortune by taking calculated risks on international trade and government bonds, earning them the unofficial title of the 6th great power in Europe alongside England, France, Prussia, Austria, and Russia. Yet all of that history, all of that prestige, all of that carefully cultivated reputation for conservative banking excellence would be obliterated by Nick Leeson's unauthorized derivatives trading that ultimately cost the bank $1.4 billion and triggered the most spectacular banking collapse in British history. Nicholas William Leeson came from decidedly humble beginnings in Watford, a working-class suburb north of London. Born in 1967, he left school at 18 without attending university and started his career as a clerk at Coutts Bank before moving to Morgan Stanley in 1987. His timing was impeccable. The late 80s represented the golden age of financial deregulation, when ambitious young men with sharp elbows and sharper minds could make fortunes in the newly liberalized markets. Leeson possessed an intuitive understanding of complex financial instruments and demonstrated an almost supernatural ability to make money in volatile markets. When Barings recruited him in 1989, they weren't hiring just another back-office administrator. They were bringing aboard someone who would become their most profitable trader, generating millions in revenue from their Singapore operations. By 1992, at just 25 years old, Leeson was running Barings Futures Singapore and earning more money for the bank than any other single trader. His success in arbitrage trading, exploiting tiny price differences between the Nikkei futures contracts traded in Singapore and Osaka, had made him something of a legend within the organization. What nobody at Barings headquarters realized was that Leeson was operating with virtually no oversight, holding both trading and settlement responsibilities in direct violation of basic banking regulations that required these functions to remain separate. The derivatives markets that Leeson operated in were relatively new financial instruments that allowed investors to bet on the future direction of stock indices, currencies, and commodities without actually owning the underlying assets. These markets had exploded in popularity during the early 90s as institutional investors sought higher returns and more sophisticated hedging strategies. The Nikkei futures contracts that formed the backbone of Leeson's trading strategy were particularly volatile, reflecting the dramatic swings in Japanese stock prices following the collapse of that country's real estate bubble in 1991. Arbitrage trading, when executed properly with appropriate risk controls, represented a relatively safe way to generate consistent profits by exploiting temporary price inefficiencies between related markets. The key word, however, was control. Successful arbitrage required precise position management, immediate settlement of trades, and constant monitoring of exposure levels. What Leeson was actually doing bore no resemblance to the conservative arbitrage strategy that Barings executives believed they had authorized. Instead of making small hedged bets on price differences, he was taking massive directional positions on Japanese stock market movements, essentially gambling the bank's entire capital base on his ability to predict short-term market fluctuations. The fatal flaw in Barings' risk management system was allowing Leeson to control both the trading desk and the settlements department in Singapore. This dual role meant that he could execute trades without independent verification and manipulate the reporting systems to hide his losses from London headquarters. When his positions moved against him, instead of cutting losses according to standard risk management protocols, Leeson would double down with even larger bets in an increasingly desperate attempt to recover his losses. He created a secret error account, numbered 88888, where he parked losing trades to keep them off the official books that were reported to London. The number 8 is considered lucky in Chinese culture, but for Barings, account 88888 would prove to be anything but fortunate. By the end of 1994, this hidden account contained losses of approximately £200 million, but Leeson's reported profits were so substantial that Barings executives never questioned the underlying positions. The bank's senior management was so impressed with the Singapore operation's profitability that they paid Leeson substantial bonuses and gave him increasingly free rein to expand his trading activities. In 1994 alone, Leeson's reported profits accounted for more than half of Barings' total earnings, making him the golden boy who could seemingly do no wrong. The beginning of the end came on January 17, 1995, when a devastating earthquake struck the Japanese city of Kobe, killing over 6,000 people and causing massive economic disruption. The Nikkei index, already under pressure from Japan's prolonged economic stagnation, plummeted in response to the disaster. Leeson had been betting heavily that Japanese stocks would rise, leaving him catastrophically exposed when the market moved in the opposite direction. Instead of accepting his losses and closing his positions, he made the fatal decision to increase his bets, convinced that the market would eventually recover and vindicate his strategy. He began selling options contracts that would generate immediate premium income, but exposed Barings to unlimited losses if the market continued falling. These short straddle positions, where he sold both put and call options on the Nikkei, were essentially bets that the Japanese stock market would remain stable within a narrow trading range. When volatility increased following the earthquake, these positions became increasingly expensive to maintain. Leeson was forced to deposit ever larger amounts of margin money to keep his positions open, requiring him to request additional funding from London headquarters. The amounts were staggering. In the final weeks of February 1995, Barings was sending up to £50 million per day to Singapore to meet margin calls on positions that senior management didn't even know existed. The requests for additional margin funding should have triggered immediate investigation from Barings' risk management team, but the bank's antiquated systems and compartmentalized structure meant that nobody in London had a complete picture of the Singapore operation's true exposure. Different departments were receiving fragments of information about Leeson's activities, but no single person was responsible for piecing together the overall risk profile. The internal auditors had actually identified serious concerns about the Singapore operations controls in a report completed in August 1994, specifically noting that Leeson's dual role in trading and settlements violated fundamental banking regulations. However, their recommendations for immediate remedial action were never implemented, partly because Leeson's apparent profitability made senior management reluctant to interfere with a successful operation. By February 1995, Leeson controlled futures positions equivalent to $7 billion, representing approximately 20% of the entire Japanese futures market. His positions were so large that they were actually moving the market, creating additional volatility that worked against his trading strategy. He was trapped in a vicious cycle where his attempts to manage his losing positions were making those losses even worse, while the margin requirements were consuming ever larger amounts of Barings' capital. On February 23, 1995, Nick Leeson sent a fax to his superior in London stating that he was taking the day off due to illness. But instead of going home, he and his wife Lisa fled Singapore on the first available flight. The note he left behind was brief and devastating. He apologized for the problems he had caused and admitted that he could no longer hide the massive losses in account 88888. When Barings executives finally gained access to Leeson's trading systems and examined the true extent of his positions, they discovered losses of £827 million, an amount that exceeded the bank's entire capital base. The unauthorized trades had been financed through a combination of fake documentation, manipulated settlement reports, and increasingly frantic requests for margin funding that had been approved without proper verification. Peter Baring, the chairman and descendant of the bank's founders, immediately contacted the Bank of England to report that his institution was technically insolvent and could not meet its obligations to counterparties. The revelation sent shockwaves through the global financial system, as traders and institutions worldwide scrambled to understand their exposure to Barings and the potential implications for market stability. The Bank of England, Britain's central bank, moved quickly to organize a rescue package that would prevent Barings' collapse from triggering a broader financial crisis. Governor Eddie George convened emergency meetings with the heads of Britain's major banks, hoping to arrange a bailout similar to the rescue of Continental Illinois in 1984 or the coordinated response to the long-term capital management crisis that would occur 3 years later. However, as details of Leeson's unauthorized trading became clear, potential rescuers realized that they would essentially be paying to cover gambling losses with no underlying assets to secure their investment. The derivatives positions that had caused the crisis were essentially worthless bets on market movements, not investments in productive enterprises or recoverable assets. After a frantic weekend of negotiations, the rescue effort collapsed when major banks refused to commit funds without government guarantees that were not forthcoming. On Sunday, February 26, 1995, Barings Bank was declared insolvent and placed into administration, making it the first major British bank to fail since the Over- Gurney crisis of 1866. The speed of the collapse was breathtaking. Less than a week elapsed between Leeson's disappearance and the bank's formal failure, demonstrating how quickly modern financial institutions could be destroyed by inadequate risk controls and rogue trading. Dutch banking and insurance giant ING ultimately acquired Barings' assets for the symbolic price of £1. Saving most jobs and preserving client relationships while allowing the Barings name to continue in a diminished capacity. However, the acquisition came only after ING had carefully examined the books and satisfied itself that no additional hidden losses lurked in other parts of the organization. The investigation revealed that Leeson's activities had been facilitated by systemic failures in Barings' risk management systems, including inadequate oversight from London headquarters, poor communication between different departments, and a compensation structure that rewarded short-term profits without considering long-term risks. Nick Leeson himself was arrested in Germany while attempting to return to London and was eventually extradited to Singapore, where he pleaded guilty to fraud charges and was sentenced to 6.5 years in prison. He served 4 years before being released for good behavior, during which time he was diagnosed with colon cancer and underwent successful treatment. His story became the subject of multiple books and a Hollywood film starring Ewan McGregor, cementing his place in financial history as the man who single-handedly destroyed Britain's oldest investment bank. The collapse of Barings Bank triggered fundamental changes in how financial institutions manage derivatives trading and monitor risk exposures. Regulators worldwide implemented new rules requiring clear separation between trading and settlement functions, mandatory reporting of large derivatives positions, and enhanced capital requirements for banks engaged in proprietary trading. The Basel Committee on Banking Supervision used the Barings case as a catalyst for developing more sophisticated risk management standards that would eventually become known as Basel II. The disaster also highlighted the dangers of derivatives trading and contributed to ongoing debates about whether these instruments served legitimate economic purposes or simply enabled sophisticated gambling that could threaten financial stability. For the Baring family, whose ancestors had built one of the world's great merchant banks through careful risk assessment and conservative lending practices, the ignominious end of their 233-year-old institution represented a personal tragedy that no amount of money could repair. The bank that had once been so influential that the French finance minister reportedly said there were 6 great powers in Europe, England, France, Austria, Prussia, Russia, and Baring Brothers, had been reduced to a footnote in financial history by one man's unauthorized trades and a management structure that prioritized profits over prudent risk control.